Welcome to the debate. Today we are focusing our lens on the Green Mountain State, specifically on a piece of legislation that seems, well, numerically insignificant, 30 cents. But it represents a tectonic shift in the philosophy of public finance.
Right, we're dissecting Vermont House Bill 863.
Exactly. It is a proposal to implement a retail delivery fee starting July 1, 2026. And while the price tag is small, the implications for the fiscal architecture of the state are massive. I'll be arguing that this fee is a necessary, logical evolution to save our infrastructure funding.
And it is a pleasure to be here. I'll be taking the opposing view. Frankly, calling it a tectonic shift might be giving it a bit too much credit. I view HB 863 less as a grand architectural change and more as a zombie policy. We saw this in 2025 under the names H426 and S75, where it failed. We saw 12 other states reject similar concepts last year. Yet here it is again, rising from the grave, attempting to fix an infrastructure problem by breaking the logistical back of small commerce.
A zombie policy is a colorful way to put it. But I would argue that good ideas often require multiple attempts to pass legislative hurdles. The core context here is undeniable. The gas tax is dying. We are here to debate whether HB 863 is the correct life raft. My position is that this fee represents a completely necessary modernization of infrastructure funding. It is a way to replenish the transportation fund as revenues inevitably decline due to, electric vehicles and higher fuel efficiency.
And my position is that while the transportation fund may be in crisis, HB 863 is just the wrong tool for the job. It is a blunt instrument. It lacks the necessary nuance we have seen in other successful implementations, like the small seller exemptions in Colorado or Minnesota. It creates a compliance nightmare regarding refunds, imposes rigid invoicing structures, and relies on administrative rules that haven't even been written yet. It is effectively a compliance project masquerading as a simple revenue stream.
I see why you would frame it that way, particularly looking at the operational friction. But let's start with the why before we get bogged down in the how. My thesis is that the retail delivery fee proposed in HB 863 is a necessary corrective to an outdated tax model. But look at the structure of this specific bill. It proposes a 30-cent fee on taxable, tangible personal property delivered in Vermont. The genius here is that it shifts the burden from the fuel to the service of delivery. We are buying more goods online, delivery trucks are using the roads more frequently. It stands to reason that the tax base should shift to capture that activity. Furthermore, HB 863 is designed for modern commerce. The fee applies just once per transaction. It doesn't matter if Amazon sends you 3 boxes or 1, the fee is flat. It is a modern fiscal tool adapted for the reality of 2026.
You call it modern? I call it administratively archaic. Let's dig into the evidence, starting with the scope of this bill. This is where the blunt instrument critique really lands.
Go on.
The source material is very clear. HB 863 applies to all vendors registered for Vermont sales tax that deliver taxable tangible personal property. Now let's look at the national landscape. When Colorado implemented their fee, they eventually exempted businesses with less than $500,000 in sales. Minnesota set their threshold at $1 million. They recognized a basic economic truth. Below a certain volume, the cost of complying with the tax exceeds the revenue generated by the tax. Vermont has chosen to ignore this.
Ignore is a strong word. I would say they have chosen a different path of fairness.
It is not fairness, it's blindness. Without a small seller exemption, a mom-and-pop shop in Burlington that ships 50 packages a year has to undergo the exact same software overhaul as Walmart. They have to update their shopping cart logic, their invoicing templates, and their back-end reporting. That is a fixed cost. For Walmart, that cost is a rounding error. For the small shop, that is a significant burden. You are imposing an enterprise-level compliance regime on micro businesses.
I think you're underestimating the agility of modern small businesses. Most are using platforms: Shopify, Square, Stripe. These platforms update automatically. It is not 1990 where you have to hire a coder to rewrite your website. But more importantly, let's look at the principle of the broad base.
The principle of squeezing everyone?
The principle that if you use the road, you pay for the road. Why should a small business get a free pass to damage the infrastructure? A delivery van sent by a small bookstore weighs roughly the same as a delivery van sent by a giant conglomerate. The damage to the asphalt is identical. If we start carving out exemptions based on revenue, we narrow the base. When you narrow the base, you inevitably have to raise the rate. I would much rather have a broad base at 30 cents than a narrow base at 50 or 60 cents.
That is a theoretical argument that completely ignores the administrative reality. And speaking of exemptions, you can't claim the legislature is against exemptions on principle. They included several in HB 863.
Exactly, which shows they were thoughtful. The bill explicitly exempts electricity, water, gas, and steam. It exempts pre-written computer software. And, perhaps most importantly for our discussion on local business, it exempts curbside pickups.
Exempting steam is hardly a concession to the modern digital retailer. That's just legacy language.
But the curbside pickup exemption is a powerful behavioral nudge. It incentivizes a model that reduces delivery traffic. If a customer drives to the local store to pick up their goods, there is no fee. If they demand delivery, there is a fee. That aligns perfectly with the goal of reducing wear and tear on the roads from heavy delivery fleets. It encourages the buy online, pick up in store model, which actually helps local brick-and-mortar shops maintain foot traffic.
While that is a nice unintended benefit, it doesn't solve the compliance headache for when delivery does happen. And this brings me to the invoicing requirement. The bill requires the fee to be separately stated on the invoice.
Transparency is a good thing, isn't it? The consumer should know exactly what they are paying for.
In theory, yes. In practice, separately stated means software redesign. You cannot just bundle this 30 cents into your shipping and handling fee. You have to break it out as a distinct line item, retail delivery fee. This differentiates it from a standard business cost and turns it into a government mandate that the merchant has to present to the customer. It invites scrutiny, it complicates the checkout flow, and as Amanda Deniston from Avalara, who is an expert on this exact type of tax automation, pointed out, the difference between a minor line item and a meaningful compliance project lies in these specific details. Vermont is leaning heavily toward compliance project.
I am not convinced by that line of reasoning because it assumes that transparency is bad for business. If I am a consumer, I want to know that 30 cents is going to the state, not into the merchant's pocket. If you hide it in shipping, the merchant looks like they are price gouging. By separately stating it, the merchant can say, look, this is the state's fee, not mine. It actually protects the merchant's reputation.
That assumes the customer understands the nuance. Usually they just see an extra fee and get annoyed. But let's move to the most contentious mechanical issue in this bill, the refund trap.
I assume you are referring to the non-refundability clause.
I am. The source material is explicit here. If an order is canceled prior to delivery, the fee is refunded. That makes perfect sense. The delivery never happened. However, if the delivery occurs and the customer returns the item, maybe it's the wrong size, maybe it's damaged, the fee is non-refundable.
And that is perfectly logical.
It is logical for the state treasurer. It is a disaster for the customer service desk.
Let's break down the logic, though. The fee pays for the use of the road. The truck drove to your house. The road was used. The carbon was emitted. The pavement was worn down. You cannot undrive the truck just because the sweater didn't fit. The service, the delivery, was fully consumed. Why should the state refund money for a service that was fully rendered and cannot be taken back?
Because we live in a retail environment defined by free returns and full refunds. That is the standard set by the giants. Now imagine a small Vermont retailer. A customer buys a $100 item. They pay sales tax and the 30-cent fee. They return the item. The merchant refunds the $100 and the sales tax. But they have to stop and say, sorry, I have to keep 30 cents because the state won't give it back to me.
Is a customer really going to riot over 30 cents?
It is not the amount. It is the friction. It turns the merchant into the enforcer of a petty penalty. It ruins the promise of a full refund. And operationally, it is a nightmare. The merchant's accounting system have to be smart enough to reverse the sales tax but retain the delivery fee. That requires complex logic in the ERP system. It requires 2 different workflows for a single return transaction.
That is an interesting point, though I would frame it differently. This is exactly where the flexibility of the bill shines. The drafters did not ignore the merchant's plight. HB 863 allows retailers to collect the fee from the consumer, but it does not require them to.
So the solution is for the business to just eat the cost?
The solution is business agency. If a retailer is terrified of that customer service conversation, they can simply choose to pay the 30 cents themselves. They can absorb it as a cost of doing business. If customer goodwill is worth more than 30 cents, they pay it. If they operate on thin margins, they pass it through. The bill gives them the choice. It doesn't mandate that the consumer sees the charge. It only mandates that the transportation fund gets paid.
A look at the market dynamics that creates. The large retailers, the Amazons of the world, can easily absorb 30 cents. They will advertise no delivery fees. Meanwhile, the local Vermont business, which cannot afford to eat that cost on every single transaction, have to pass it on. They have to show the line item. So the law effectively makes the small business look more expensive and more bureaucratic than the giant competitor. It tilts the playing field even further against Main Street.
I would argue the playing field is already tilted by economies of scale. 30 cents isn't going to be the deciding factor in the demise of local retail. But the per-transaction structure, which we touched on briefly, actually protects the smaller players and the consumers more than you admit.
How so?
In the early drafts of delivery fees across the country, there was a fear of a per-package model. If I order 5 things and they come in 3 boxes, I pay 3 fees. That penalizes logistical inefficiency. Vermont's HB 863 is strictly per transaction. 1 sale, 1 fee. It creates certainty. It prevents a consumer from being penalized because a retailer has a disorganized warehouse.
I will grant you that per transaction is superior to per package. However, even the definition of a transaction can get messy in the digital world of subscriptions and partial shipments. But I want to pivot to the administrative timeline because this is where the compliance project label really sticks.
The timeline seems generous to me. The fee wouldn't take effect until July 1, 2026. We are discussing this well in advance. That is over a year for businesses to prepare.
A year to prepare for what exactly? The Vermont Department of Taxes still has to determine how to report this. The source material explicitly states the reporting mechanism is TBD.
That is standard procedure. The legislature passes the law, the Department of Taxes creates the form.
But the form dictates the workload. There are 2 ways this goes. Method A. Vermont adds a line to the existing sales tax return. You file monthly, just like sales tax. Minnesota does this. It is relatively streamlined. Method B. Vermont requires a completely separate return, a new form, a new login, a new deadline. Colorado does this. If Vermont chooses Method B, they are effectively doubling the administrative filing burden for every merchant in the state. We are asking legislators to vote yes on a bill where the mechanism of compliance is a total question mark.
I am not convinced by that fear-mongering. Why would the Department of Taxes choose the harder path? They have the Minnesota model right there as a blueprint. The source material confirms the reporting schedule follows the sales tax schedule. If you file monthly for sales tax, you file monthly for this. The rhythm is the same. It is highly likely they will integrate it into the existing portal.
Highly likely is not a guarantee, and businesses hate uncertainty. Until we see the draft forms, we don't know if this is a minor tweak or a major headache. And remember, even if it is on the same form, the back-end data requirement, separating taxable versus exempt delivery items, remains.
But that data separation is necessary for the sales tax anyway. You already have to know if an item is taxable to charge sales tax. You are just using that same data flag to trigger the delivery fee. It is not inventing new data. It is leveraging existing data.
It is leveraging it in a new, complex way. But let's zoom out. We have talked about the mechanics. Let's talk about the trend. You framed this as the modernization of tax policy. I look at the data and I see a failed experiment.
How can you call it failed when the revenue need is so high?
I call it failed because of the rejection rate. In 2025, 12 states considered retail delivery fees. 12. Do you know how many passed?
I know the history.
None. 0. Vermont itself tried with H426 and S75. They died in committee. If this is such a logical evolution, why is it facing such universal rejection across the country? Why are legislatures, both red and blue, looking at this and saying, no, this isn't worth it?
Because change is hard. And because the gas tax, while dying, hasn't fully collapsed yet. Legislatures are reactive, not proactive. They are kicking the can down the road. But look at who is considering it for 2026. New York, Hawaii, Nebraska. These are vastly different states with different economies. The fact that the idea keeps coming back, despite the political failures, proves that the underlying problem is real. The structural deficit in the transportation fund isn't going away just because politicians are afraid of a new fee.
But maybe they are finding better ways. Maybe they are looking at vehicle registration fees, or tire taxes, or mileage-based user fees that don't involve deputizing every retailer in the state as a tax collector. The pushback mentioned in the source material isn't just political noise. It is a recognition that the administrative cost, the collective millions of dollars businesses will spend to update their systems, might actually exceed the net benefit to the state in the early years. It is inefficient economics.
I would argue that crumbling bridges and pothole-ridden roads are the ultimate economic inefficiency. We are moving from an analog economy of gas pumps to a digital economy of delivery trucks. That transition requires a new fiscal architecture. You can call it friction, I call it growing pains. We cannot solve 2026 problems with 1990s tools.
And I would argue you cannot build a new architecture on a foundation of red tape.
We are at a philosophical impasse, which is exactly where we should be. We have covered the scope, the mechanics, the refunds, and the national landscape. I think it is time to synthesize these positions for our listeners.
Agreed. Let's bring it home.
I will let you start. Summarize the case against HB 863.
My position remains that HB 863 is a well-intentioned but poorly designed policy. By failing to include a small seller exemption, Vermont is casting a net that catches minnows alongside whales, imposing enterprise-level compliance costs on the smallest businesses in the state. The operational headaches, specifically the requirement to separately state the fee on invoices and the consumer-hostile refund trap, create unnecessary conflict between merchants and their customers. Furthermore, the looming uncertainty regarding the reporting forms, whether it will be a simple line item or a separate return, adds a layer of risk that businesses simply don't need. 12 states rejected this in 2025 for a reason. It is a policy that creates friction for every delivery transaction in the state, and I believe the administrative pain outweighs the fiscal gain.
And I see it as a necessary step toward fiscal reality. The free ride is over. For too long, the shift to e-commerce has allowed heavy delivery vehicles to use our infrastructure without paying their fair share, leaving the dwindling number of gas car drivers to foot the bill. HB 863 is a modest 30-cent step toward fairness. It is structured to be simple, one fee per transaction, not per package. It offers flexibility. Retailers can pay it themselves if they choose to protect their customers. And it wisely protects the vulnerable by exempting essential utilities like water, gas, and electricity. We need to fund our roads, and taxing the service that uses them, delivery, is the most logical, forward-looking way to do it.
It is certainly a shift. Whether it is a successful one will depend entirely on the execution.
Indeed. And for the retailers listening, the takeaway is clear. Do not ignore this. If HB 863 passes, July 1, 2026 is the day the rules change. Watch the Department of Taxes closely.
And maybe start budgeting for that software upgrade now, just in case.
Absolutely. That brings us to the end of this broadcast. We hope this exchange has illuminated the complexities behind what might seem like a simple 30-cent charge.
There is always more beneath the surface.
Thank you for listening to The Debate.